David Semmens is US economist at StanChart's Bank, which is, of course, the world's #1 firm for economic forecasting, according to Bloomberg data. So we're in good company. Thank you very much indeed for coming in. First of all, what are you going to be watching for?
I mean, the main thing is really just to make sure that they're not getting any more concerned. As you said, the data has been slightly better, but it's not been anything to get too excited about. And also, it's a one-day meeting, so they're not really going to make any major policy changes today.
All right, so what about a potential change of stance that could come a little bit later on? Many of the economists that we've been speaking to say that Bernanke is likely to revise that pledge on keeping rates close to zero, but you disagree with that?
I would. I mean, I think they're going to stay on rates going to stay on hold for longer, if anything. I think they're more likely to change in the third quarter of 2013, and I think, if anything, we're going to see further QE at the March meeting simply because inflation is going to top out, and once inflation's topped out, with unemployment so high, they really are going to do more QE rather than less.
But what about the argument that QE has done actually very little to resolve the issue of structural growth problems and the fact that, well, if it hasn't been effective thus far in terms of bringing down the unemployment rate, why would more QE make any positive contribution in that respect?
Well, I mean, the main reason for doing further QE is just to keep longer-term rates low, and that's ultimately the aim. Basically, the Fed's main mechanism for working is keeping rates low, and if you start to see the back end pick up, which ultimately you would want to do once you'd seen further QE, because then people are going to be seeing more inflationary pressures, but also feeling that the growth outlook is going to be good. But at the moment, we don't have a strong growth outlook, and people are looking for inflation to come off. And so the last thing we want to get into is a downward spiral with regards to inflation and get into a deflationary concern like we had a couple of years ago.
So when you say that the outlook for growth isn't great, what are you expecting in the US next year? An ongoing soft patch, slowing growth, another recession?
Well, we're expecting a particularly weak start to Q1 simply because you're going to have a lot of investment pulled forward into the fourth quarter of this year due to the investment tax credit. But we're really looking for it to gather pace during the year. But we're not looking for a particularly strong year. We're only looking for 1.7, which is still below trend and not really enough to bring unemployment down significantly at all, if at all even.
Right. So when we look at the unemployment rate as it is right now, obviously very sticky at 9%, just a little bit above that. What's it going to take to bring that number down? When will we see something below 9%?
Well, I mean, at the moment you're sitting at 8.6, but the vast majority of that has been due to the participation rate, because people have been leaving the labour force, and when people who leave the labour force, it tends to be the unemployed, and so that artificially brings the unemployment rate down. You really should be seeing the unemployment rate sitting around 12% at the moment if you put back into the labour force everyone who left because they've lost heart. And unfortunately, that's really what's keeping wages weak. It's going to keep consumer growth pretty stagnant going forward. And really what you want to see is jobs growth of over sort of 200,000 before people can really get carried away and say, right, we're going to see unemployment come down aggressively and we can feel encouraged and the Fed can raise rates.
Well, third quarter GDP came in fairly healthily. We had growth of around 200,000 for non-farm payrolls earlier on in the year. I mean, we could potentially see that again next year, couldn't we?
We could. I mean, we're looking more for sort of 150,000 marks simply because we don't feel that growth is going to be particularly strong. And we also feel that people are holding off from hiring at the moment. And also there still is potential to increase the hours of people who are already working. There's lots of people working part-time, and people who are going to increase the part-time workers' hours first before they go out and hire aggressively. And you want to see that increase happening first, and we're really looking for that to happen in the first half of the year before you see any aggressive hiring.
So then what is it going to take for companies to have the confidence to start hiring, to start investing, to start spending?
I think just feeling more optimistic about the outlook. I still think at the moment people in the States are less so than Europe worried about the outlook, but they are still concerned about how things are playing out and how global growth is going to look.
All right, thanks very much indeed. David Semmens, US economist at StanChart's Bank.